Hello, and welcome to the AB Disruptor series, where we weigh in on critical topics that are shaping the capital markets. I'm Rick Brink, Senior Vice President and Market Strategist at AllianceBernstein.
Artificial intelligence is everywhere, but what powers it is often overlooked. In this episode, we go behind the algorithms and output to examine the critical ecosystem that underpins AI. Our panel of experts highlights the key links in the AI supply chain, from raw materials and semiconductors to data centers and energy demand, and why they matter to investors.
And hello, everyone, and welcome. I'm Rick Brink. I'm here with Ian McNaugher, Mike Mathay, and Luke Pryor. I'm here in New York. Welcome, gentlemen. Thanks very much.
Thank you.
Yeah. And joining us from London is Wentai Xiao. Those of you that joined us on the last Disruptors on Healthcare will recall that Wentai was on to speak to the role of accelerated compute and AI in healthcare specifically. But today, we will be focused squarely in her playground, the AI ecosystem. So hello, Wentai. Thanks as always for joining.
Hi, Rick. Thanks for having me.
As we all know, up until the U.S. election, or maybe just the first 100 days, the major AI players have largely dominated investor conversations, media coverage, and index attribution for quite some time, and generally for good reason. But to state the obvious, and the reason for our getting together, no data centers, no AI. No power, no data centers. And each major link has smaller links, and so on, and all of those, for the most part, are investable. So, with that in mind, today we have two main objectives. The first is to bring the links of the AI supply chain to life, share our thoughts on them, tell some stories. And given that, the second is to discuss investing along the supply chain. But to kick things off, Wentai, and set the stage, let's begin with a statement and a few key questions on the major players. We know the Mag 7 is largely synonymous with AI, but it's important to note here that what's at stake for the cohorts are not the same. So my first question, Wentai, is who is spending on AI? How much, and most importantly, why?
Yeah, thanks, Rick. So there's definitely a lot at stake in this AI build out. If we think about, the old technology regime, so that's digital advertising, consumer internet, Windows operating system, mobile operating system, the old regime created, nearly $500 billion of profits for the winners. So that's what's really at stake, because now there's a new technology regime, AI, which promises to redistribute all technology profit pools, starting with the bottom, the most fundamental layer of the technology stack, which is computing. So, we should think about AI almost as more forced investment at this point, rather than several large companies simply choosing the next killer app. So to kind of set the stage for that, a bit of context, you have Google trying to defend its search profit pools from OpenAI. You have Microsoft and Amazon trying to defend their cloud businesses from two clouds that are emerging. You have Apple, who's navigating, an AI hardware cycle, if there is one. You have Meta, who was defending position in digital advertising over the last 2 years, but now it's on the hunt for new profit pools, possibly in enterprise software. And you have Tesla, who's trying to make AI and self-driving into a must-have feature for cars and transportation. So really, maybe just to set the stage for us, think about $500 billion of profit being at stake, and, about $500 billion of CapEx going into the ground now in order to build that out. And you have these large companies that are defending their existing profit pools and trying to carve out a new place in the sun for themselves at the new regime. And, sort of what this AI build is about.
Thanks very much, Wentai. Let's begin at the beginning. And we'll start with the beginning of the supply chain, rare earth elements and not so rare earth elements, at least according to classification. This is going to be an admittedly brief stop here. Apologies. Really two reasons for this. One is honestly time. We have a lot to cover across power and data centers and the big players. We had to sort of pick our spots a bit. But the second is because of the nature of the space today. Anytime we have a discussion about rare earth elements, or again, elements more broadly and how they feed into AI, we're talking about a world that is heavily concentrated. Geopolitics and policy play a massive role. And so you have the security of the future portfolio, where energy security is one of them. Let's talk maybe a little bit about that backdrop, and then we'll get into a couple of examples that I think will maybe kind of bring to life the approach.
Sure. So look, rare earth elements are interesting for a lot of reasons. And probably the first one is that they're just not that rare in the earth. For the most part, they're not. If you look at, for example, neodymium, which is used for magnets, this is constantly discussed when you see headlines about rare earths. Do we have enough rare earths? Magnets is one of the things that people focus on the most. But neodymium it's in lots of places. We have a lot of it in the ground in the US. It's a lot in Australia. There's a lot in China. There's a lot all around the world. What is rare about it and what makes it interesting, what ties it up in the geopolitics you're mentioning, is that the processing and the refining of that, bringing it from kind of the raw ore into actually a finished magnet, that is something that today happens predominantly in China. 90+% of processing and refining for these really happens in China. We mine some of it here in the US, we mine it other places, but that part of the supply chain really only goes through China. That's something that for a number of years, I think there was a general degree of comfort with, but with how the world is evolving from a geopolitical perspective, there's a lot more stress about that. And that's why you see the headlines that you're seeing. That's why you see kind of more debate when there's the trade discussions going on. You see rare earths as a part of it. It's that China really dominates this piece of it that matters for a whole bunch of areas. When we think about data centers, we think about power, all that type of stuff. Magnets are important because magnets really play a principal role in converting between motion and electricity. You use them for generators, you use them for turbines. And so if there were some reason that the finished magnets weren't available, it would cause a huge bottleneck for the construction of a whole bunch of different things and would cause the data center construction to be challenged as well. The flip side of all of what I'm saying is that these are problems that can be solved. For the most part, they can be solved. And so things like refining and processing, they're more expensive to do in the US, but we can do them here. Those facilities just need to be built. And some of them are beginning to be built. It's just going to take some time. And what that means is that until that happens, there is a bottleneck. There is geopolitical concerns. There's stress around it. There's a real push to try to secure supplies as early as possible for companies downstream that need this type of stuff. But in the longer term, I think a lot of this probably does get resolved. Now, I mentioned neodymium. That's a light rare earth element. Where the story is a little bit different is in what they call heavy rare earths. Those are a bit more rare in the earth. And actually, the reserves of those are primarily located in China today. There's some in other places, but there's not that much. Those are things that they're not make or break in the same way that kind of rare earths broadly are. But what they do is they allow magnets to be used in hotter conditions and more difficult conditions. And so that's very important for the auto supply chain. It's very important for kind of high stress applications. That's something that, frankly, hasn't really been figured out that well yet. And it's an area where there also is a lot of consternation, a lot of stress, and a lot of focus on companies on trying to figure out how do we ensure that we have security of supply of these elements in a world where geopolitical fractures are getting a little bit wider. Supply chains that cross from one geopolitical alliance to another is getting a little bit more uncertain.
Well, since you brought it up, neodymium, then let's talk about that, because I know that's an area that you look at. So how do you then approach neodymium, and how do you look at it from an investment perspective, given what you said?
We really think of it, there's kind of two opportunities there. The first one, the basic one is, like I mentioned, we're trying to build factories to do some of this stuff. There are companies that are on the other side of that. If there's a build out of a rare earth supply chain in the US, you need bulldozers to go get the sites ready. You need to use electrical equipment to build up the factories to do it. There's just companies that they sell the things you need and they're going to be selling more of them. That's good. Earnings go up. Stocks generally go up when earnings go up. So that's an interesting place to be. We like that type of exposure broadly. The more interesting exposure, though, that we look for is trying to own bottlenecks. And figuring out where the bottlenecks is, it isn't always easy. Figuring out how long the bottlenecks last is also not always easy. But when we look at rare earths, as I mentioned, it might not be a bottleneck forever, but it's increasingly a bottleneck today. And there's a handful of ways to invest in that, and companies that have access to rare earth supply today, companies that might be some of the first to market with processing, with refining, being able to do kind of a full end-to-end vertical supply chain in the US, they make for interesting investment opportunities. You know, everything has the right price, and there's a lot of work to be done to figure out how long does this last? How much excess margin can you get while this is going on? But we see, in general, the most exciting ways to invest in this is, look, if you own something that people need and they can't get that much of, it tends to be a really good time for the company, and it tends to be a really good time for the equity holders.
Thanks, sir. We're segueing into power generation.
Sure.
So I'm going to toss another one out that I know you talk about, and that's uranium. And you know, there's a lot of focus on rare earths, but obviously there's a lot of things that are not theoretically considered rare earths that also matter. Every time I go to get on a plane and they ask me if I have a lithium battery that's in my check bags, I'm reminded of that. But that's not the one I'm going to toss at you as my segue into power generation. I'm going to ask you about uranium.
They're both interesting, actually, but uranium maybe even more so. So look, uranium, it's the fuel for nuclear reactors. So if you want to have nuclear power, you need uranium. It needs to be processed. It needs to be refined. It needs to be enriched. There's two challenges with uranium today. The first one, well, actually, let me start with what's not a challenge. What's not a challenge is it's not that there's not uranium out there in the earth. This is another one of these. There is uranium out there. It exists. It is accessible on kind of a longer term horizon. But you have these two challenges. The first one, which is really for about 10 or 15 years, pretty much starting with the Fukushima disaster years ago, people stopped investing in the supply side of uranium. Nuclear power had gone from being seen as kind of an ascendant source of power to something that people were trying to move away from. And you saw shutdowns all around the world for a variety of reasons, but that accident in particular drove a lot of that. People thought there wasn't going to be as much need for uranium, so new mines didn't start. Mines started to slow down. But what we're seeing today is there's now a resurgence of interest in nuclear power, which I'm sure we can talk a fair amount more about. That's going to need more uranium, but because no one's invested in that supply side, we just don't have that much uranium ready to go. That's a solvable problem, but investing in new mines, that takes 10 years. It takes a while. It'll come. These things are already starting. But in the meantime, there's really a shortage of uranium relative to what people would feel more comfortable with. That's the first problem. The second problem, which is maybe a little bit more interesting and a little bit more volatile, is that uranium, you can't just dig it out of the ground and put it into your reactor. Like everything else, any other type of kind of raw element, it needs to go through a whole series of stages. It needs to be processed, refined, it needs to be enriched. That refining and enrichment capability today, globally, about 40% of it goes through Russia. That is no longer seen as a viable, secure partner by a lot of countries in the West, but they have no choice but to rely on it today. It's unclear exactly what's going to happen from a geopolitical point of view. Maybe that all ends up fine. A lot of those trade flows, for the most part, are going. But there's also been a lot of discussion about sanctions. There have been various ways that those trade flows have been impacted. And I think as a lot of buyers of uranium are looking further out, they don't feel comfortable relying on the Russian supply coming to market in a way that they can access for the long term. And so that means that something else needs to be developed. There needs to be a new supply chain that's located in places that they feel more comfortable with. That's something that's starting. Those things are starting to be built. We're seeing more enrichment facilities being kind of plans coming out in various places, but it'll take a little while. It'll take some time. So again, you're in a situation where these things can be solved, they can exist, but the world that we have today embeds kind of a globalized reliance for these structures that I think people felt a lot more comfortable with 10 years ago than they do right now.
You know, as you're saying this stuff, I'm thinking of friend-shoring, which is around for a long time. Well, in the last handful of years. This sort of sounds like friend sourcing that we're talking about. Does that sound like a fair way to think about maybe an investment approach?
Yeah, it's a very good way to put it. And, it's interesting because we're in a world where I think those friendships, they're getting redefined, they're evolving. I don't think anyone really knows exactly where we land. But for example, the US, it relies enormously on Canadian uranium. That's been seen as a much better source than Russian uranium. But also relations between the US and Canada have been different recently than they have been for a long time. Time will tell what that looks like if we go a year down the road, 5 years down the road, 10 years down the road. But I think all around the world, kind of everyone who's trying to access these specific types of minerals, specific types of elements that they may or may not have in their own borders, they're just giving a lot of thought to how can we bring as much of this into an area that we feel more secure about, that we feel like we have more sovereignty over than we have before. And it's a really different approach than how most of these decisions were made for 20 or 30 years.
Thank you. And now I'm going to use my get into the power generation free card from the uranium nod to talk about those sources. So let's start with nuclear and let's set the stage, right? We're going to start with power generation, make our way into transmission distribution. Let's start with power generation nuclear.
Sure. So look, nuclear is interesting. Nuclear is exciting. The things that are good about nuclear is, first, it can provide baseload power. And that's important. A thing that we need for data centers and for whole other sources of power demand is power that you can rely on, that is there 24/7, that you know is accessible. Nuclear can do that. It has extremely high uptime. It runs regularly. That's great. The challenge with nuclear, or the key challenge with nuclear, is that, frankly, in this country, we are not very good at building it. We had a huge nuclear build out decades ago. That has really came to an end decades ago. We've really built effectively one new project in the last few decades. It went terribly, way over budget, way over schedule. And we want to have more now, but we don't have those muscles. We don't have the labor force. We don't have the plans. We don't have all the capabilities you build up from doing something again and again and again. So we want to build these large scale reactors. It's not clear if we're going to be able to do that. And if we do, how long that's going to take, because these are not quick or easy things to build, and they cost an enormous amounts of money, tens of billions of dollars. But that's part of the nuclear story. The other part of the nuclear story is that there's a whole bunch of new types of nuclear reactors being designed. So these are called SMRs, small modular reactors. The idea behind these is that there's a whole bunch of different ways of doing it, but it's basically you take a reactor, you make it much smaller, and it's something that instead of tens of billions of dollars, it costs single-digit billions of dollars. Instead of taking 10 years to build, maybe you can do it in a few years. And maybe that can get you kind of over the challenges we've had with building new large-scale nuclear reactors, where you need a lot more capital and a lot more time than we have. The secondary benefit is once you start building those, you can also get through your reps more quickly. And so you can build 1, 2, 3, 4, 5, and each time you'll do it a little bit better. Maybe that's a way to get kind of further down the nuclear cost curve. It's a really nice idea. We have a number of designs out there that look quite promising. Some of them are shrunken big reactors. Some of them kind of do things differently from the ground up. We haven't built any of them yet. We might, and there's a lot of people looking to do that. But these types of things, they're hard to do for the first time. So it doesn't mean it's not going to happen. It doesn't mean that we won't get there. But it means that in the near term, as we're looking at kind of the ongoing surge in power demand coming from AI, coming from data centers, coming from a whole bunch of sources, it's not clear that this is going to solve anything in the next few years. Maybe it will in the 2030s, but it's probably not in the second half of the 2020s.
Another big area of discussion in power generation on the renewable side. Can we talk about solar, wind, and storage?
Sure. So look, I think a theme that's going to come through all of this is there's a lot of different potential sources of power generation, and they all have their challenges. They all have their benefits, and they all have a role to play. But there's no white knight. There's no one thing that we can look at and say, hey, this is going to solve things for us. So solar and wind have become extremely common in kind of new projects being built over the last decade or so. And the biggest reason for that is economics. Both of them, but particularly solar, have rapidly moved down the cost curve and are economically cost competitive when they're generating electricity with really most other sources of power generation out there today. There's been help from government programs there, but frankly, if you look at the economics today, even without the government programs, for the most part, they're cost competitive. When you look at interconnection queues in the country and you look at the projects that people are signing up to build, 90% of them are renewables, 90+% of them are renewables. And that's a testament to this stuff works. The economics is they are pretty good. So what's the challenge? So why can't we just solve this? We'll go build a whole bunch of solar and wind. I guess I would first say just between the two of them, it's not exactly the same trajectory. Solar is moving down the cost curve faster than wind is. Offshore wind, within wind, that hasn't worked out so well. It might still work out, but at least as we sit here today, it doesn't look that competitive. A lot of projects haven't worked as well as people originally expected. Onshore wind is a fair bit better. It's just not as effective as solar is. So there's a lot of wind out there in the country. We're going to keep building it. But for the most part, solar, if you're trying to do the cheapest thing, that's where you would go. Now with solar, the most obvious challenge with solar, obvious to everybody, is it works when the sun is shining. And that's great. And so you have sunlight, you have a nice sunny day, you get lots of power from your solar panels. That's good. That's free fuel. It doesn't really cost anything. And you see there are parts of the country where there's a lot of solar in the grid where they have even free energy or negative power prices during the day when it's a sunny day when the sun is shining. But when we think of data centers and we think of, frankly, anything, we want to be able to run it all the time, not just when the sun is shining. And so then you run into, okay, well, what about storage? Could we hook up batteries to this? The solar panels, they charge the batteries while the sun is shining, and then the batteries, either on a rainy day, at night, maybe they're providing to the grid. And that's true. That works too. And there's a lot of areas where the economics of that are pretty good. But it doesn't solve all the problems. First, the economics of batteries, they work better the more you're using the batteries, which generally means that you need to have kind of shorter recharge cycles and shorter discharge cycles. So if you have a battery where you're just charging it because there's a few times a year you want to use it, those economics aren't great. If you're trying to use it every night, maybe that's okay. The second piece is a lot of the batteries, their economics are really best when they're used to store a few hours of energy, 3, 4, 5 hours, not 6 hours, not 10 hours, not 12 hours. So what does that mean? That means that when you're in a situation where, hey, the sun's going down, but everyone's watching TV, that's probably fine. You can probably have really good economics on battery storage. You do that every day, that's great. But let's say you have a 3 or 4 day rainy period where you're not generating much electricity. Batteries probably don't work that well for that situation. Let's say you move from summer to winter. Now the sun is lower in the sky. You have shorter days, you don't get as much solar energy. Batteries aren't great for that either. So storage can bring solar from being a pretty narrow solution to a broader solution, but it doesn't get you to kind of that full day 24/7 power, at least not yet. At least we're kind of not there with the current technology, with the current economics. So it's part of the solution, just like nuclear is part of the solution. But again, we can't look at it as, oh great, well we'll only build solar panels and now we'll be able to power everything that we want.
Okay. One more I want to sneak in, because I like to talk about it. And I'm sort of looking over at Mike in case he jumps in. Gas turbines.
So gas turbines, they've been the solution for a while in this country. We have a lot of cheap gas in this country. Gas turbines work very well. We've had the technology for a long time. That's what we use to increasingly to power the grid today. What's the problem with gas turbines? It's that we haven't built many gas turbines for 20 or 30 years. Power demand has been more or less flat. Now it's trying to grow again. And our capacity for gas turbines is allocated, or it's structured really in accordance with that flat power demand. So that means that all of a sudden the gas turbine manufacturers, and there's really only a couple of them, they're sold out through the end of the decade. And they're sold out because they're building all the ones they can. They just don't have the factory space. They don't have the capacity to build more. And they're adding a little bit, but they're only going to add so much, because when you add capacity, you're making a 20 or 30 year decision. And gas is something to be really, really useful to use for the next few years. It might be useful to use in the first part of the 2030s, but no one knows what that looks like in 2038, 2042, 2050. And so it's really hard to add too much capacity with that level of uncertainty. And so gas turbines are a great solution. They're going to be built. They're going to be part of the grid. But again, there's just a limit on how much they can be. And Rick, I think that gets to the broader point, which is, look, that can be part of the solution. Solar and storage can be, wind can be, nuclear can pick up more at some point. Coal, the economics don't work anymore. We're not building any of that. Hydropower, we've used most of the good resources. Geothermal is a really exciting idea where there's a lot of new things happening with geothermal, but we're still years away from that being at scale. biomass, burning wood for energy. That's something I think we all hoped that we would be getting further from, not closer to. So there's all of these things out there. There's all these ways that we generate energy today and generate electricity today. They're just all challenging. They're all challenging to kind of meet the needs we have, which is this 24/7 reliable. You plug things in, it works all the time. You know it's going to be there. And by the way, we want that to work for plugging a lot more things in.
The two key words that are clearly coming through here are bottlenecks and challenges. So as almost a kind of rapid fire on the investment side. All right, so distill all that and then tell me how you're trying to go through all these options for Power and Invest.
You know, it's some of the same stuff that we talked about with the rare earth elements, where we really see kind of two broad ways of playing it. The first one is, as these things get built, there are companies that benefit from that. If you're building solar farms, if you're building new gas generation facilities, like you need the bulldozers, you need the engineering and construction firms, you need all those things. And there's a lot of companies in those spaces that have seen their business do really well just as a result of there being a lot of interest in building this type of stuff. A poster child often for this is Quanta Services. They've done phenomenally well the last few years because they're the ones who go out there, they have the labor, and they engineer these facilities, they build these facilities. It's a great time in their business. They're making tons of money doing exactly this type of stuff. But again, the most interesting thing is the bottlenecks. From an investment perspective, goes back to if supply is limited and demand is going up, that's a really, really good place to be. The poster child for that, for the last year or two, that's been GE Vernova. They're one of the few gas turbine manufacturers that's still out there today. When I mentioned that we're sold out pretty much through the end of the decade, they're sold out pretty much through the end of the decade. They're making a ton of money on their gas turbine business, and all indications thus far are that that's something that's just going to continue to move up. They're in a really good position as a result, and so they've been the bottleneck. They've been kind of the clearest example of the returns that can accrue to the company that owns the thing that we need a lot of, but we don't have that much of.
Thank you, sir. We've sort of been dabbling in the power generation infrastructure, but there's sort of two parallel tracks here. Mm-hmm. The other is this sleepy little part of the world for most people, which is the utility space, but this is a big deal. So if you could, let's start with energy in general, the last 20 years or so in that journey it's taken to the discussions we're having now versus that, because it matters for what utilities and what infrastructure look like and what they're trying to catch up to. So let's start with this story.
Sure. So the most important things to understand about the utility sector, the electric utility sector in the US over the last 20 years, call it, are the growth themes and then industry structure. So on growth, what's broadly true is that electric demand has not really grown since, call it, 2010 until very recently. But despite that, what's probably underappreciated is that the utility sector, which went through a halted effort at deregulation. So fast forwarding today, we have regions in the US, notably the Mid-Atlantic and Texas, that are deregulated markets in that power generation assets are deregulated. As a result of that sort of start-stop process, we went through a period of severe underinvestment. And actually, in the past 15 years, the utility sector has transitioned more and more to being a growth industry. The growth drivers just weren't driven by growing power demand. They were really driven by replacement demand. So on the grid side, you just had sort of the theme you see in a lot of sectors where aged infrastructure, broader need for ongoing reinvestment. On the power side, we have actually been growing power capacity in this country consistently for years. And that's a lot to do with the fact that we've been retiring a ton of coal generation. We were even retiring a lot of nuclear generation until recently, and that thematic has changed. So to piggyback on what Luke was saying, we're not really building new nuclear in this country for a number of reasons, but we're no longer retiring it. And what were originally supposed to be 40-year assets could very well end up being 60, 80-year assets. But we've been growing capacity because what are we replacing coal generation with, which was designed to run pretty much 24/7? We're replacing it with intermittent resources like wind and solar. So you need to build 2-3x the capacity in the ground. So we've been building power capacity, we've been building grid capacity. What's different now is a replacement growth cycle is running into a actual demand growth cycle. And so it's not like the sleepy utility sector was no growth and then suddenly everyone can accelerate. Everyone was kind of at almost the thresholds of where they could grow because they were running up to other limiters like ultimately customers pay for the assets in the ground. So there are affordability pressures, there's cost of capital pressures. So today growth is accelerating, but you're already sort of seeing bottlenecks in the forms of cost of financing, affordability challenges before you even consider supply chain parts availability.
Okay, so then where do we go from here? So there's our challenge and our bottleneck. So how do we sort of see this transpiring a little bit on a go-forward basis? And I want to throw something out because this is something I really got into the weeds on with you for the first time, is this sort of regulated versus deregulated and how that really sets the stage for the way you even think about investing.
Yeah. So on regulated versus deregulated, basically you have two different investment opportunities with two totally different risk profiles. With respect to the traditional vertically integrated utilities, these are assets where power generation, transmission, and distribution are all regulated assets. The utility business model is actually very simple. Put CapEx in the ground, grow that asset base. These utilities earn a regulated return on that asset base. In the absence of demand growth, selling more kilowatt hours, you grow by growing assets. Demand growth and replacement just puts further pressure on that need for investment. And so you are looking for companies that have the best combination of that growth opportunity. Is it a growing service territory like Texas, and growing replacement need, as well as an accommodative regulatory framework? You want utilities that can actually earn on that investment opportunity. Which companies have the biggest upside? On the deregulated side, sort of as a bizarre result of how deregulation in this country played out, you had a number of companies owning power assets in deregulated markets, selling power at prices largely driven by natural gas prices, which, as Luke pointed out, is really cheap in this country. And so these were financially strained assets for a number of years, basically, especially the deregulated nuclear plants, which are these large fixed cost assets that have to sell 24/7 into plummeting power prices. As a result, these were sort of assets that no one really wanted. And today, almost all of the deregulated power assets owned by public companies are owned by pure play companies. They're not really owned by the regulated utilities anymore. So you have a small handful, Constellation Energy is one, Vistra is another, that own deregulated assets, and the opportunity there is scarcity value. These companies aren't really in the business today of building out their generation portfolio. They're trying to monetize the existing assets they have. Some of them have really unique opportunities. If you have a deregulated nuclear power plant, you have a unique opportunity to potentially contract that asset with a data center provider. We're seeing that today. Constellation Energy has announced 2 different 20-year virtual contracts with Meta and Microsoft, where effectively they're agreeing to sell the megawatt hours from their plants at a fixed premium price. And the hyperscaler is willing to do that because they get price certainty, but they also get to say, we're adding clean power to the grid at the same time. And they also benefit from, in a sort of direct supply and demand way, they get to benefit from higher power prices. Power prices go up if demand goes up. So those are sort of the two very unique investment opportunities today.
Let me piggyback onto that, because another conversation that we had, another this and that, is, as you're talking about data centers specifically, is the idea of front of meter and back of meter.
Yep.
Why don't you tell everybody what that's about and why that's a big deal?
So back of meter, or behind the meter, is just the concept of, can I actually just build a data center in this case, or some kind of large demand center, and plug it directly into the power plant, and effectively say, I'm just going to get power directly from this, and I'm not going to avail myself to the services of the grid. Controversy there is like it's literally like taking whatever that capacity of that plant is off the grid, and no one ever truly connects to a power plant and doesn't avail themselves to certain grid services. So then you have a cost shift controversy where who's paying for it if you're just removing capacity from the market, and the other people on the grid have to pay for grid services that this plant is effectively avoiding. Front of meter is your traditional model. You're just plugging into the grid. So when you read about Microsoft signing an agreement with 3 Mile Island, they're just going to connect to the grid normally. They don't have to build their data center next to 3 Mile Island. They're just committing to pay Constellation Energy a fixed amount for whatever kilowatt hours that plant generates, and there's not much controversy around the cost shift and them not paying for grid services.
Okay, so a couple of questions we want to sort of file in here is, with all this in mind, what's sort of the big question or questions that you go through with all this going on? Because again, back to the challenges and bottlenecks, what's the sort of issues or the big things that you're going to be focusing on, you think the industry is going to have to deal with?
The biggest ones, and this is nothing new, is really just what is the cost of capital, right? So this investment story gets a lot easier if rates are lower, if equity valuations are higher, and affordability has mitigants that the industry is still working on. So one would be just load growth. So a big debate now is, are we in a cycle where demand growth is sustainably real and positive? If that's true, then a lot of utilities suddenly have more of their investment dollars socialized over more kilowatt hours. That solves a big customer bill challenge that wasn't there before. The other stuff is around like automation and efficiency, right? Like you can imagine this is sort of a slow moving industry. There's still, I think, in the early innings of doing a lot around automation and, automatically detecting issues on their grid. I mean, that helps make crews more efficient, and anything you can do around making operating expense more efficient solves an affordability challenge.
Thank you. And you did mention some of the players already in the space, but any other either from an investment approach perspective or other companies you'd like to mention that sort of fit into how we think this plays out and who benefits?
Mm-hmm. So I think on the traditional regulated side, it's what I said before. You're kind of looking for the companies that have the most credible upside to the pace of their investment, have a credible way to finance it, either because they have a lower cost of capital or because they're in a state that has that demand tailwind, or they're just in an accommodative regulatory regime. There are the companies that benefit directly from the fact that we're just going to continue to build new power capacity in this country, and maybe that pace of investment needs to pick up. So that might be a company like a NextEra that has approximately 40% of its profit from actually being a direct power developer, predominantly renewables, but also gas. And then you have the short list of these deregulated independent power producers that it's more about exploiting scarcity of their resource. And so their opportunities are more around, if demand is real, then power prices go up. Their assets are more valuable. That's an ability to contract those. And we're sort of in a regime where they're not going to build new power, but they do have an opportunity to buy power assets at pretty compelling valuations and exploit a sort of a pricing arbitrage.
Thank you, sir. There's so much to talk about. But we have managed to get to power generation, infrastructure sort of discussion, utilities as we're running through here a little bit. I know you were chomping at the bit when we were on power generation, but I want to come to infrastructure on down the line and make our way through transmission and distribution, because it's so much fun talking to you, because it's the whole thing. And one thing we'll get into is it expands into the data center. Correct. But for now, take me through the transmission distribution and sort of the way you're seeing that side of the world.
Right. I think it's worth, on the foundation that we've set with utilities and the generation, it's worth just spending a minute talking about what the grid is and how it looks. Mm-hmm. So for the last 100 years, the grid is pretty much operated the U.S. grid is pretty much operated in the same way. Put it into context, there's something like 600,000 miles of high voltage lines that run across the United States. There's a couple thousand of the large transformers that you see to step the power from a generation up to the high voltages that need to go across the high voltage lines. There's about 30,000 substations that are involved in then stepping that power down into about 6 million transformers across millions and millions of distribution lines that take it to a data center or to a home or wherever. For the last 100 years, it's basically worked in that order. There's a generation source, there's a coal plant or something that's off in the distance, generates the power, steps up into transmission, runs across, steps down in voltage into the distribution, and goes into whatever customer use there is. For the last 15 years or so, the demand in the U.S. has essentially been flat. There has been economic growth, but that's been offset by efficiencies. What has changed in that time period are two things. One is this migration from the traditional fossil fuels into solar, wind, hydro, and other sorts of renewables. Those plants are not in the same place as the coal and the gas plants that we've used for most of the last 100 years. They also, as Luke pointed out, have intermittency challenges. So you need to have some of them work some of the time and others. What you end up with is a much more complicated grid. As opposed to one-way power flow, now you have multi-directional power flow. Assets that have to work together to ensure a certain level of reliability and resilience in the grid. So that's complexity is the first theme here. The second theme that we've been talking about here is the inflection demand. So as opposed to growing roughly 0.5% for the electricity demand, growing 0.5% for the last 15 or 20 years, we're now at a point where that's inflected. Estimates are all over the place, but I think people are generally looking at something in the range of, call it 2, maybe 3% expected annual load growth over the next 10 years. 2 or 3 doesn't sound like much, but that's 6 times the level of demand growth that we've been absorbing before. At the same time, the utility operators are dealing with all the challenges that Ian has already outlined. Now, from an infrastructure standpoint, this is an enormous opportunity because as we add the complexity, there's a need for more equipment in different places. there's a need for much greater intelligence across those as the assets need to work together. And now we've layered on a demand growth scenario on top of that. And you have a situation where those constraints, whether it's at power gen or at the utilities or even at the equipment providers themselves, are just another constraint in the process of providing the demand growth that we're talking 2 or 3%. But if we focus in on the data centers, it's a large portion of that and growing much faster, and it has much more specific power quality and reliability needs.
Thank you. So against that backdrop, how do you start to even break down or dimension the investment side of this? Before we get to what you like or where you look, how do you start to break it down against those needs?
Yeah, so I spoke briefly about the differences between transmission and distribution, and there are different players in each of those. Broadly speaking, when we're talking about transmission, we're talking about utility scale transformers, substations, and certain types of switching equipment that tend to be really global players. Those are big projects, big scale, tough economics, but it tends to be dominated by global players. Hitachi, Mitsubishi, Siemens, certain parts of GE, legacy play in that area. As you move up across the wires, you have some dedicated wire and cable players. That is also because it's a commodity reliant business, a very tough place to play. As you move down into the distribution end of things, you get smaller equipment, you get lots of intelligence and lots of complexity. Here you move down into smaller transformers, you move into switchgear, and you move into the equipment that then actually is in a facility, whether it's a building like this, or a data center, or a home, breakers, backup power, quality meters, power distribution equipment, all of those things. Highly dynamic environment and a different set of companies there.
So with that in mind, what do you like? How do you go about it? Or what do you see?
So for our purposes, there's so much complexity and so many constraints here. What we're really looking for are places where we don't have to get too many bets right. And there are a few cases where you've got equipment players like a Schneider in Europe or like an Eaton, who is the market leader here in the United States. And there are a few other players beyond that, where if we do a little more nuclear or a little more solar, it doesn't matter, because it still gets converted into electrons that creates demand for the equipment that they provide. If the demand at the end user side is a little more EVs or a little more data centers, it also doesn't matter. So I don't have to pick the winners and losers there. What I've really got are picks and shovels players that are benefiting from the growth in demand and the growth in complexity. So those are two that we really think about. If I wanted to expand it a little bit, I might add Quanta Services that Luke mentioned earlier. They are among the leading players that actually build the grid and have built most of the U.S. grid in the last 50 years.
Thank you very much. So Wentai, hanging patiently in London while we make our way through power generation and transmission and distribution, the infrastructure side, the utility side, a little bit of elements, but the data centers are the big thing. And for a lot of folks, it's just a giant box that holds data. I've come across this in my conversations. And so one of the things that you and I talked about is, can you bring to life the inside of a data center? Because all the stuff in it and how it's designed is, first, incredibly interesting. The scale is unreal. And secondly, the investments and the nature of investment cycles is crazy.
Yeah, thanks, Rick. Yeah, definitely. I think what might be useful is for us to maybe spend a bit of time on, just what is the accelerated computing solution that's being put in place in these AI data centers, and then to tie that back to the discussion that you guys have been having around power. So why are power needs going up? Why are the sizes of these data centers growing? So accelerated computing, what is the point of it? So if you think about the old world, you have one workload like email or logging into, your workday, and that runs on one CPU. And that CPU might be in your desktop. It might be in a server, in a closet in your office, or it might be in the cloud. And every year that CPU gets, 10, 20% more powerful. So the workload you can run on it gets 10, 20% bigger. But now you think about the new world we're living in. There's a new workload, which is Gen AI. And this new workload is about constructing hundreds of billions of parameters in a giant matrix. That's what we refer to as training for AI. And then multiplying out that entire matrix, which is, what we call inferencing. And so it's impossible to fit that big of a workload into a CPU. So what we needed to do is invent a computer that's big enough to run a giant workload like generative AI. And so we invented accelerated computing around 2016. And really, that was about figuring out how to connect tens of thousands of processors together to behave as though they were a single supercomputer. So we're going from, one workload on one processor to one gigantic workload on tens of thousands of processors that have been bound together to behave as a single computer. And that is the accelerated compute paradigm. And if you think about it, as AI gets more intelligent, the models are getting bigger, which means the number of processors that you need to connect actually goes up. The power of each of those processors also needs to go up. And so as long as model sizes keep evolving from, 100 billion parameters to 1 trillion parameters, as long as, the ecosystem keeps adopting new AI techniques like reasoning models, which consume more and not less computing, then what we'll continue to see is that the sizes of these supercomputers, the sizes of these clusters, they will get bigger. So they'll go from 10,000 GPUs to 100,000 GPUs to 1 million GPUs. And the data centers in turn that are holding these things are going to get bigger and bigger, from 50 megawatts to 200 megawatts to 1,000 or 1 gig to even 2 gigawatts and 5 gigawatts at some point. So that's really kind of the point of accelerated computing and why it's exerting this, upward pressure on just the scale of computing, the scale of data centers. And if I may, Rick, there's a lot of different things that go into what makes accelerated computing, the paradigm I just described, possible. So I'd like to just walk everyone through a couple different layers in the accelerated computing stack. So first, in order to make accelerated computing possible, we needed to invent a networking layer that's capable of having many GPUs talk to each other as though they were a single computer. So NVIDIA invented a networking fabric called NVLink to do that, which is a copper-based interconnect. So GPUs talking to one another over that network, that's what we call scale up. And then in order for racks of GPUs to then talk to one another, that's what we call scale out. And in order to make that possible, you need, a combination of digital signal processors or DSPs that are sold by companies like Marvell. You're going to need optical transceivers, which are sold by companies like Coherent and Lumentum. And in the networking switch level, you're going to need switches that are sold by NVIDIA, Broadcom, Arista Networks. So that's really the first really critical layer that we had to innovate. The second really critical layer is that, these are very complicated processors at the compute level, whether we're talking about GPUs from NVIDIA or TPUs from Broadcom. And these chips require, a special packaging technique, which is called CoWoS, which is a way of packaging these compute dies such that we can actually combine chiplets. We can, integrate them with high bandwidth memory, which we'll get into in a moment, so that we can improve signal processing between them, and we can handle the heat generation from these very powerful processors. So that new way of packaging compute dies is something done by Taiwan Semiconductor. Third, we needed a new type of memory. So as the computing is getting denser, we need more memory. But if you imagine a memory chip as a single pancake, there's only so much memory. There's only so many transistors we can cram onto the surface of that single pancake. So we came up with a way to densify memory literally by stacking 8 pancakes on top of another. And that, stack of 8 pancakes is basically one big high bandwidth memory or HBM chip. And that required a lot of innovation, not only from the memory companies like Hynix and Micron, but also innovation from specialized equipment providers like Hanmi, in order to figure out how do we actually glue the pancakes together, right? So that the DRAM layers in each of those pancakes can actually go and talk to one another as though they were one gigantic, DRAM chip. Fourth, we had to because we have to cram a lot more computers together, we had to figure out a better way to cool them that wasn't just traditional, traditional air cooling with fans and pumps. So we had to come up with a way to circulate, coolants in tubes, that run up and down the back sides of these supercomputers. So that liquid cooling, involves companies like Vertiv and Asia Vital. And if I may kind of try to paint the picture of the final product, just imagine the ultimate product as, in the case of the current generation NVIDIA system that's being shipped today, the Grace Blackwell 200 NVL72, we're talking about 72 GPUs interconnected to behave as though they were one computer, using high bandwidth memory and liquid cooling. It's the size of a giant refrigerator. And each of these giant refrigerators basically are about 3,000 pounds in weight. They consume about 130 kilowatts per hour. So think of that as the equivalent of like a large supermarket during peak operations, but crammed into a refrigerator-sized box. And then if you walk into one of these data centers, what you will see is you're going to see these 50,000 GPU type of clusters. So that's kind of what the whole stack sort of looks like inside the data center.
I had so much fun going through this, by the way. Just so you know, I tried really hard to get Wentai to refer to the glue as syrup, because it would have really tied together the stack of pancakes really well. Just wouldn't budge on it. But even the technology in cooling that's been advanced, and this is something that I learned that I didn't know. Inside of a data center, we have sort of white space and gray space. And I know you tend to play in the gray space. You want to add anything on there, Mike?
Yeah, so I think it's a great distinction to bring in. So everything that Wentai has described falls into what we call the white space of a data center. That's really, it's the server room. That's where all the computers and the IT-related equipment sit. Wrapped around that, what we would call the gray space. And that's where more of the industrial grade power equipment and the cooling infrastructure starts. The power comes off the grid, goes through some switchgear, like a giant circuit breaker, and then it moves through an uninterruptible power supply that essentially serves as a connection to the backup power in case we lose the grid connection, but also provides critical services in cleaning what is otherwise a fairly noisy electrical current, so that the very expensive high-power compute machines don't blow up. Then that moves into the white space where you have power distribution units that are at the rack level as well as the rows of racks level. So it kind of blends into the two. The cooling side, which sits right on top of that then, is a blend. Right. So historically, data centers have essentially run like other commercial buildings with traditional air conditioning units. So you might have like a Trane or a Johnson Controls or a Carrier with rooftop mounted systems like a traditional air conditioner. As Wentai said, as the power moves up in these computer systems and the heat generated goes exponential, those solutions don't work anymore. And so there are a variety of cooling systems that are being developed. It's still actually a very dynamic environment. People are playing with what's called direct-to-chip cooling. They're playing with immersion cooling, where you literally sink the server equipment into some sort of a fluid. And there are other technologies. Vertiv, she mentioned, plays in this, but so do some of the legacy players. Trane, I mentioned earlier, also a big player in this. But as that compute density goes up, your ability to use the traditional method goes down, and you have to begin with some hybrid solutions, and eventually the expectation is that you'll have to move fully into liquid. And there are a lot of players that are in this area. She mentioned Vertiv, I mentioned Trane, even companies like Ecolab, which you wouldn't think of as being in this place, but they have a lot of technology around water management, water flows, pushing chemistry through very small tubes and then monitoring that in real time. They're also opening up some really interesting opportunities.
Every time I go through this setup of cooling and giant boxes and liquid and tubes, I think of the Matrix. There's no way to not think of the pod, because it just visually, that's what it is to me. All right, Wentai, I want to come back to you because there are so many links in the chain, and Wentai went through a lot of them. We didn't even scratch the surface on the things that you're not even thinking about, like that giant 7.5 foot tall box that Wentai was talking about. They have to have support things in there that will hold thousands of pounds. Right? And that's made by somebody in the middle of somewhere, right? And that all gets assembled. So sifting through this entire sort of data center supply chain, Wentai, how do we go about finding returns?
Thank you. It's a great question because there's so many suppliers, right, involved to just make that single accelerated computing system possible, right? So in compute, networking, memory, obviously we have NVIDIA, Taiwan Semi, Broadcom, Coherent, Lumentum, Micron, Hynix. For the power management chips that get attached to these servers, we have Infineon, Monolithic Power, onsemi, Renesas, Texas Instruments. In packaging and testing, you have companies like Amkor, KYEC. Still in interconnects and in cabling, you have, Amphenol, T Connectivity, BizLink, and a bunch of others. So, there's hundreds of actual suppliers, and then maybe call it 30 or so, large kind of publicly traded companies that are really intimately involved. And so, a big question for us as we're thinking about how to get attractive, risk-adjusted exposure is we think there's a couple of big dynamics in the industry to keep in mind. The first one is that the product cycles are really compressing. So whereas in the past, you might have been replacing enterprise servers, let's say once every 5 to 7 years, now we're introducing these new accelerated computing systems every year. So that means every year, these suppliers can get designed into these systems, but every year they can also be designed out, right? So that immediately puts a question of just, the durability of your moat and the duration of your participation in the AI growth opportunity for all of these semis and hardware participants. The other consideration is you could keep your design win, but as we have seen, as these product cycles have evolved, next year, you can go from being 90% of that socket to now you're sharing that socket with, 5 other companies. So even if the, end unit volumes could be inflecting on pricing, your gross profit capture could change. So that's the first really important dynamic to keep in mind for investing in the space is just the pace of the product cycles. Second, because the product cycles are moving so quickly, in some cases, we're seeing companies move off of the global standards bodies, which is really remarkable compared to the last 40 years of semiconductor and optical innovation, right? Like if you take networking, for example, right? Like the world's companies have historically moved together in lockstep, once every 3 years or so. And if you take something like global wireless, right? Think about the standards bodies that go into 3G and 4G and 5G. These are all coordinated, globalized efforts. And now you have a situation where NVIDIA is moving so quickly that they've moved off of the global standards bodies. There's like 3 distinct networking ecosystems that are emerging in the data center. And so that means that some significant portion of R&D, it's not going to be all marching in the same kind of direction anymore. There's going to be distinct competing ecosystems where companies are, throwing R&D resources after very heterogeneous roadmaps. And that means that, there can be risk of permanent capital destruction if companies actually end up, tying their destinies to the wrong ecosystem. So that's the second thing that's important is that at the same time that you have this, geopolitical fracturing in a lot of these supply chains, you're also getting a technology push that is kind of moving off of the global standards bodies. Third, how things actually evolve depend to a great degree on how quickly AI use cases actually materialize and stabilize. So, for example, within computing, there is a whole debate around programmable GPUs, such as provided by NVIDIA, and custom silicon, such as provided by Broadcom and Marvell. So maybe for the next several years, AI remains incredibly fluid. So AI models will keep changing. AI model techniques keep changing, such as the reasoning technique emerging. And therefore, you want to keep most of your infrastructure in programmable architectures like GPUs. So that kind of situation would argue for much higher GPU versus custom silicon share. But on the other hand, what if it turns out to be the case that AI use cases become crystallized a lot faster than expected? Maybe model innovation stalls out. Like after this big reasoning push, there isn't something else that takes us from 1 trillion parameters to 2 trillion parameters, or there isn't this change in the way that we do inferencing that requires us to really elongate the compute time to think in order to come up with answers. So in the case that, use cases become crystallized and the underlying models actually stabilize, so the model innovation slows down, then maybe we can lock in a substantially greater portion of our inferencing workloads on custom silicon. So we can freeze the programs that we need to run in the transistor architecture. We can tape out much cheaper chipsets, right? And then in that world, you would have a much higher custom silicon share and a much lower GPU share, right? So that's the third big dynamic to keep in mind is what's happening inside the AI workloads is going to govern the types of semiconductor hardware optical infrastructure that the hyperscalers and enterprises want to deploy. And then fourth, of course, everything I've been talking about is all about bifurcation within AI, right? There's also the just overall AI complex, which is that we're going to be undersupplied for some time. Then we could enter periods of digestion, which will impact demand for the overall complex. And that just happens, right? It already happened in 2019 with traditional cloud, which was in 2019, the hyperscalers, which had been spending quite a lot of CapEx to build out traditional public cloud infrastructure between 2016 and 2018, they went into a digestion period in 2019. So in that year, cloud CapEx was down 1%, even as public cloud revenues still grew over 20%, right? And that didn't mean that the secular trend for public cloud is over, that we're not migrating to the cloud anymore. It just means that as you are scaling along this build out, it's not going to be linear, which I think is very well understood, for kind of the cyclical nature of these build outs. So that's the fourth thing to really keep in mind. So for us, if we take those four kind of overarching investment dynamics together, a lot of our process has to be focused on, staying on top of long-term technology roadmaps, understanding how, as architectures change, the destiny of different companies will change. So depending on what happens in networking, depending on how we solve problems and scale up versus scale out, that's going to radically change the future for people that sell copper-based interconnects versus optical-based interconnects, and then within copper and within optical. Third is really about understanding what's priced in for future growth at current prices. So if we get these moments like DeepSeek, right, which was really misunderstood, the knee-jerk reaction of the market was, oh, now we're doing reasoning models, so we don't need as many chips, we don't need as many boxes. Whereas the reality was, to adopt reasoning models, we actually needed way more boxes, right? So just understanding what is being priced in at any given point for these stocks is extremely critical for actually giving us, more buffer. And then, fourth, staying on top of all of the new developments in the supply chain and just overall remaining very active in the way that we are participating. And lastly, at the, total portfolio level for the tech fund and for global disruptors, the two products that I support, just being very sensitive about the overall sort of portfolio exposure that we're carrying and making sure that, we're balanced all along the spectrum, depending on how these architectural roadmaps play out, and also depending on where we are in the actual AI CapEx build cycle.
Thank you very much, Wentai. And thank you, everyone. With that, we have come to the close of another Disruptors. First, a huge thank you to my colleagues here in New York. We've got Ian and Luke and Mike, and in London, Wentai, for your time, your insights, and all the work going into this. I really, really appreciate it. This is a hugely important space. And thanks, as always, to everyone for joining. I hope you found this dive into the supply chain useful and will be helpful for in your conversations, your efforts with your own clients. As always, we will look to follow up on all the questions and requests received in the coming days, but feel free to reach out to your AB representative with any questions as well. Thank you again, everyone.
Thank you all for listening. We hope you enjoyed today's episode, and we'd love to hear from you. If you have any questions, comments, or feedback, please email us at disruptor@alliancebernstein.com. And join us next quarter for another episode of the Disruptor series by Alliance Bernstein.